Hello, savvy investors. Welcome back to today. We're embarking on an exploration into the realm of value investing with a spotlight on a timeless masterpiece, The Intelligent Investor, penned by the iconic Benjamin Grahm. This book isn't just a guide, it's a beacon of wisdom for all who tread the path of investing. The principles it imparts, coined by the man often hailed as the father of value investing, have not only withstood the sands of time but continue to illuminate the dynamic landscape of today's financial world. Whether you're a seasoned investor or just starting your journey in the vast investment universe, this book has invaluable insights to offer. If you're ready to sharpen your investment acumen, you're in for a treat, so fasten your seatbelts as we prepare to unravel the key insights from this investing tour de force. Let's delve into the wisdom of the intelligent investor. One of the cornerstone concepts Grahm introduces is the margin of safety. Now, what does this mean? Imagine you're a tightrope walker. Would you rather walk a rope that's just above the ground or one that's stretched across a high-rise building? Of course, you'd prefer the former, right? That's because it has a higher margin of safety. The same principle applies to investing. The margin of safety is the difference between the intrinsic value of a stock, which is its true worth, and its market price. It's like a safety net that protects you from the unpredictable swings of the market. When you invest with a margin of safety, you're buying securities at a price that's significantly lower than their intrinsic value. This reduces your risk and maximizes your potential for long-term gains. It's a simple yet powerful concept that forms the bedrock of value investing. So remember, it's not just about buying cheap stocks, it's about minimizing risk and maximizing the potential for long-term gains. Grahm categorizes investors into two types: the defensive investor and the enterprising investor. This classification is not about one being superior to the other, but rather it's about aligning investment strategy with personal temperament, time availability, and financial goals. Let's first delve into the defensive investor. This type of investor seeks safety, consistency, and a hands-off approach. They are typically not interested in spending considerable time and energy on investment management. Instead, they prefer to build a diversified portfolio of high-quality, low-risk stocks and bonds. It's like setting the sails and letting the wind do its work. The defensive investor's mantra could very well be, "Slow and steady wins the race." But what about those who are more adventurous, ready to plunge deeper into the financial seas? That's where the enterprising investor comes in, taking the helm in their investment journey. They are willing to dedicate time and effort to identify and capitalize on market inefficiencies. They actively seek out undervalued securities, meticulously analyzing financial statements, market trends, and industry developments. They are the detectives of the investment world, always on the hunt for the next great opportunity. But remember, with greater potential rewards come greater risks. The enterprising investor must be prepared to weather the storms that can come with active investing. It requires not only financial acumen, but also emotional resilience, as the waves of market volatility can be daunting. So, which type of investor are you? Are you the set-and-forget defensive investor, content with consistent lower risk returns? Or are you the enterprising investor, ready to roll up your sleeves and dig for buried treasure in the market? There's no right or wrong answer here. It's all about finding the investment strategy that best suits your personal circumstances and financial goals. And whether you're defensive or enterprising, the principles of value investing can guide your journey to financial success. The enterprising investor, on the other hand, is more active, seeking out undervalued opportunities through in-depth analysis. An iconic metaphor in the book is Mr. Market. Imagine, if you will, a business partner who is wildly unpredictable. His name, Mr. Market. Each day he comes to you offering to buy your share of the business or sell you his. Now here's the catch. His asking price swings wildly from day to day, sometimes even from hour to hour. One day he's the picture of optimism, quoting high prices for the shares. The next day he's down in the dumps, ready to sell his shares at a pittance. This, my friends, is Benjamin Graham's personification of the stock market. The mercurial Mr. Market embodies the irrationality and volatility that is often seen in the stock market. His daily price quotations are akin to the ticker tape, constantly streaming the latest market prices. Now, you might think that Mr. Market's erratic behavior would drive you mad, but Grahm suggests an alternative approach. He advises investors to view Mr. Market not as a guide, but as a servant. When Mr. Market is overly optimistic, offering high prices for your shares, you sell. When he's overly pessimistic, offering low prices, you buy. But here's the key. You should only act if it suits your interests. If Mr. Market's prices don't align with your assessment of the business's worth, you don't have to do anything. You're under no obligation to engage with him. In other words, don't let Mr. Market's mood swings dictate your investment decisions. His manic-depressive nature can lead to mispricing of shares, creating opportunities for the savvy investor. But to take advantage of these opportunities, you need to keep your head focusing on the fundamentals of the businesses you own. Remember, the market is there to serve you, not to guide you. Don't get swept up in the euphoria or despair of the moment. Instead, stay calm, stay rational, and stick to your investment principles. Grahm advises investors not to be swayed by Mr. Market's mood swings and to focus on the fundamentals of the businesses they own. Throughout the book, Grahm emphasizes the importance of adopting an investor's mindset rather than a speculator's mentality. This is a fundamental principle that resonates throughout the pages of The Intelligent Investor. So, what does it mean to have an investor's mindset? Well, it's about focusing on the long game, not getting caught up in the frenzied pursuit of short-term gains. It's about understanding that investing is not a sprint, but a marathon, requiring discipline and patience above all else. And when we speak of discipline in investing, we're talking about sticking to a well-thought-out investment plan regardless of the market's ups and downs. It means not being swayed by the latest trends or succumbing to the fear of missing out. Instead, it's about staying committed to your investment strategy even when the market seems to be moving in a different direction. Patience, on the other hand, is about resisting the urge to constantly tweak your portfolio or jump on every new opportunity that comes your way. It's about giving your investments the time they need to grow and understanding that the most substantial returns often come from long-term compounding. But adopting an investor's mindset also means embracing a long-term perspective. It's about looking beyond the immediate and focusing on the bigger picture. This perspective helps you to avoid making impulsive decisions based on temporary market conditions. Instead, you remain focused on your long-term financial goals and the steady journey towards achieving them. This mindset is not just about how you approach your investments. It's also about how you react to market fluctuations. Instead of panicking when the market dips or celebrating when it soars, you maintain a level head, understanding these fluctuations as part of the natural ebb and flow of the market. Having an investor's mindset means you're not swayed by these short-term movements. You're not reactive, but proactive, making decisions based on solid analysis and sound judgment, not on emotions or fleeting market trends. He encourages investors to approach the market with discipline, patience, and a long-term perspective, steering clear of emotional reactions to short-term market fluctuations. In essence, Grahm urges us to invest not with our hearts, but with our heads, guided by wisdom, not whim. Grahm delves into the concept of intrinsic value, urging investors to assess the true worth of a security rather than relying solely on market prices. At its core, intrinsic value represents the actual value of a company, independent of its stock market value. It's determined by looking at fundamental aspects such as the company's earnings, assets, liabilities, and overall financial health. So, why is intrinsic value so crucial? Well, it helps us distinguish between a company's perceived value and its actual worth. For instance, a company's stock may be trending high due to market hype, but its intrinsic value could tell a different story. Now, onto market fluctuations. Grahm sees these inevitable ups and downs not as impending doom, but as opportunities. When the market price of a stock falls below its intrinsic value, savvy investors see a chance to buy. Conversely, when the market price is significantly higher, it might be time to sell. He argues that market fluctuations should be seen as opportunities rather than reasons for panic, emphasizing the importance of fundamental analysis. As we wrap up, The Intelligent Investor leaves a lasting legacy as a comprehensive guide to intelligent investing. It's a beacon of wisdom, illuminating the path to successful investing through principles of value investing, margin of safety, and the investor's mindset. Benjamin Graham's teachings, encapsulated in the metaphor of Mr. Market, emphasize the need for discipline, patience, and a long-term perspective in the face of market volatility. Graham's categorization of investors into the defensive and enterprising types provides a useful framework for us to assess our own investment strategies. Meanwhile, his advocacy for assessing the intrinsic value of securities, rather than being swayed by market prices, encourages us to dig deeper, analyzing the fundamentals of the businesses we invest in. We've only scratched the surface of this investing masterpiece. For a deeper understanding of Graham's principles and insights, I encourage you to delve into the book itself. Remember, investing is not about timing the market, but time in the market. Stay wise, stay invested, and I'll catch you in the next video. Happy investing!